So the Fed met today, and guess what they decided to do with the rates? They decided to leave them unchanged. That means that if you were expecting for some type of rate cut, now is not the time. And let's see what the news have to say. So let's go right in to the article courtesy of the Wall Street Journal. So once again, the Fed is holding rates steady for the first time since July. For those who are brand new to the whole topic of the rates and the Fed, I do want to share with you that in 2025, there were 3 rate cuts in total for a total reduction of 0.75 in interest rates. Now, the Fed doesn't directly impact mortgage rates, but it does impact the rate the banks charges among themselves when they lend money to themselves, and also impacts your rate if you were to apply for a credit card, or if you were to apply for a car loan or personal loan. It also impacts your HELOC or any business loans if you happen to be a business owner. Same thing happens with your existing credit card interest rates. Depending on what the Fed decides, whether to increase or lower the rates, that will have an impact on your interest, because credit card interests are actually variable. So if you haven't been paying attention to your credit card bill, make sure you look back to the past 6 months, look at your statements and see if there has been any rate reduction in your statement. If not, you might want to give the bank a call and inquire about the possibility of lowering your rate. Based on the Fed decision. Now, granted, that doesn't mean you're going to get that reduction, because that's sort of like a courtesy that they do only for customers who have a good credit score and a low usage on the credit cards. If you happen to have your credit cards maxed out, chances are they might not really bring the rates down. Just something to keep in mind. Now, going back to the article of the journal, so there has been a pause on the rate, and the decision is to keep the rate between 3.5 and 375, and this was based on a 10-2 vote. Just to give more context, the Fed, it's actually divided into 12 different districts, and each district has a governor, and so they decide to make decisions and they do vote. And so based on what we saw in the article, 10 of them decided to, or voted in favor of maintaining the rate as it is, and then 2 of them voted to continue to lower the rate an additional 0.25 or 25 basis points. As expected, majority rules, so it's been held steady with no changes for this month. Now, I want to actually come down here just to give you a little bit of a perspective on the rates for the past 25 years, because this is important. Currently, we're sitting right here. And I know from a year ago, this looks like not much, but in fact, it is a breather. Let's just put it that way. It's something that's going to ease up the tightness financially, so to speak. But just so you know, there were prior periods and where the rates were actually up high. In fact, in the early 2000s, the rates were actually even higher. So always keep things in mind that if you happen to be expecting for rates to come down, typically the reduction of the rates always comes with some type of bad news. So for example, if you were to pay attention to the period between 2008 and 2015, you can see that the Fed kept the rates at near zero, but that was because that happened after the Great Recession, the financial crisis of 2008, then followed by the pandemic. Even though that's short-lived compared to the recession, you can see that the rates were reduced, but the pandemic had a cost as well. It had a financial cost. And so always keep that in mind to consider or keep things into perspective that yes, having access to cheap money, paying lower interest is always feels great, but the underlying problem is actually bigger than that, because if you happen to be going through a tumultuous time, that means you can lose your job, your business can lose revenue, and if you happen to have investment properties, that means your tenant can also lose their jobs, and that means either they could be behind on their rent or not paying rent at all. So always take things with a grain of salt. But overall, we are experiencing a bit of a breather when it comes to interest rates. Yes, it would have been nice to see another reduction, but the truth is a lot of experts didn't really anticipate a rate cut, at least not for this meeting. So sitting where we are, this is relatively good compared to prior years, and is not as high as the news make it seem. Another point that I want to highlight here, it's this, right? So what led to the decision, right? So according to the Wall Street Journal, the decision followed an interval of political pressure from the White House, and the Justice Department this month opened a criminal investigation into statements made to Congress last year by Powell, who disclosed the proof in a video statement, casting it as a pretext to advance Trump's desire for lower interest rates. There's more to it. I don't want to get into politics. I want to go to a section, and I had it here before. It was someplace. I don't know what happened, but I was reading that just right before the call. Okay, here. So the decision, here is the paragraph I was looking for. So the decision, widely expected by investor, barely registered and market. Major stock indices were a little change, and the yield on the benchmark 10-year Treasury note edged up to 4.25 from 4.244 on Tuesday. Just so you know, if you really want to pay close attention to what will be impacting the rates on your mortgage, pay attention to the 10-year Treasury note. That is what has shown over time to have more of a direct correlation to what happens to the interest rate. If you're in the market looking for a car loan or applying for a new credit card, yes, pay attention to what the Fed is saying. But contrary to popular belief, the Fed doesn't really directly impact the mortgage rates. The Treasury bonds do. And so the reason for the decision, back to the article, without further labor market weakening, the next cut might not come until after Powell's term as Fed chair ends in May, and they're likely on hold for a while unless there's a big surprise. So that in part influenced the reason why the interests were not changed in this meeting that just ended today. And also, as you can see, we shouldn't be anticipating any other major cuts, at least for the first half of the year. And now, what I want to do is to navigate into this article, courtesy of Bankrate, that share 5 things for you to pay attention to. Okay, so it is obvious that once I want to highlight this, that the policymakers might not see the rate cut as urgent, but Americans are feeling it because there are other economic pressures that we are feeling, right? The household essentials are increasing in price, groceries, electricities, heating costs. Yes, there's been a slight reduction in interest rates, but inflation, it's still here. Everybody feels it. The sentiment is there, right? So what can you really do, and what should you be on the lookout for now that you know that there is not a major rate cut, at least for the first half of the year, right? So one thing is that the mortgage rates, they could fall before the Fed rate cuts again. Why? Because once again, they go in tangent with the Treasury. Okay, so if there is any changes in the economy, that will directly impact the yield that the 10-year treasury offers. And so depending on changes in economic growth or inflation, that could impact the changes in rate without you necessarily having to look for the next FOMC meeting. Okay, so that means that if you're in the market to buy a house, you don't necessarily need to wait for the Fed next rate cut, because the relationship is directly tied to the treasury. Another thing that is worth highlighting, and this is something that I've noticed by experience, is that if there is an anticipation of the Fed, the rates tend to move prior to the meeting. So for example, if there is an anticipation that the rates are going to go down or whatever, the rates, they tend to go further down prior to the meeting. And then after the meeting, they tend to get a lot more volatile. So I wouldn't be surprised if the mortgage rates increase tomorrow because of what happened today at the meeting, regardless of what the Fed decided to increase or leave the rates unchanged as it did happen this time, right? Now, one thing that I want to move forward to is that if you are looking for some type of release on the lower interest rates, the good news is, once again, that because of the rate cuts that we have been having over the past year, the 12 months, you could reach out to your credit card companies and request an adjustment. Same thing if you happen to be in the market looking for an auto loan. Let's say you decided it's time for you to upgrade, let it be your personal vehicle, or invest in a good vehicle for your company. Now is the time to do it, because you, at the end of the day, right now, you're benefiting from 3 rate cuts from 2025. And even though there hasn't been a rate cut on this meeting, there's still none that is anticipated for at least the first half of the year. So unless you can afford to wait another 6 months, and even that, it's still a big maybe. So if you want to get your hands on a vehicle and purchase it through a loan, now is the time for you to do that. Same thing for HELOCs. If you're looking to tap into the equity of your home, now is the time to do that, because HELOC, they are variable. So they go based on what the market rate is. And so this is a good time for you to take advantage of the sort of like discounted rate. Okay. So another point I wanted to highlight here, who are the rate cuts for? Typically, according to what we see in this article, the rate cuts are meant to help the job seekers, but workers might have to keep waiting. So for those who haven't been paying attention to the news, there has been studies that show that current people that are currently employee, they are holding tight into their jobs, and that has a lot to do with the economic uncertainty. They're afraid of massive layoffs, so they want to play it safe. And so that, in a way, doesn't really open up a lot of room for the job seekers to replace those roles. And in addition to that, the jobs report has been a little weak, and companies are not announcing any additions of additional job openings. So that means that whoever's looking to transition from one role to another, or newly graduates, for example, are gonna have a hard time looking for jobs. And if there was some type of rate cut, that will in a way incentivize the economy, and in a way it will encourage some type of business lending, business wanting to reinvest in their own infrastructure or create more jobs because they're having access to cheaper capital, and that in essence translates to a higher hiring rate, so to speak. Okay, so that's all the update I wanted to share. If for whatever reason there is any questions you guys have, feel free to share that now in the chat box. If not, you can always leave your question down in the comment section below after the replay is made available online. So we have our first comment here from Anthony. Hi. And then great content. Thank you. Thank you for tuning tuning in. So once again, anyone who has questions, now is the time to ask them. Anything about the housing market or the interest rates. Oh, one thing I forgot to mention. So gold has been in the news a lot. So I wanted to actually share this with you. This is where gold is sitting right now. Okay, so to access this information, all you have to do is just to go to kitco.com, and this rate over here, it changes in real time. So depending on the time of the day that you're checking, that's the spot price. So 1 ounce of gold is right now sitting at 5,448, while a gram is sitting at 175. And then if you have the capacity to go for the kilo, that's sitting at 175,648. As you can see, the chart is recently updated. Gold is heavily traded as well, in the stock market. So not the stock market, in the market overall. So you might want to consider looking into that if you want to diversify your investment. Now, one of the questions that I've asked, and I hear that over and over again, is this still a good time to buy gold, right? And so before I even answer this question, first, you need to ask yourself, what are you looking at gold for? Because if what you want is to have access to liquidity that you can tap into in the next couple of months, gold might not be the vehicle for you. Gold should be seen as insurance for your money. Okay. Let's say, for example, the Fed decides to, I don't know, print out more money, for example, and you see more and more bills being printed out. What does that mean? There's more bills circulating in the economy. So that means there's a currency devaluation, because the more there is going around, the less of the value is. And you will notice that whenever there's an announcement to print more money, you will see a spike on the gold price. Same thing with any political turmoil or anything that has to do with the economy. Like, for example, this year, the gold has fluctuated a lot in price, and generally trending upwards because of all the whole immigration issues, the tariff issues that you see in the news. And that's why you see gold going up high. So it's not so much a matter of, oh, is it too expensive for me to get in? It's more of like, what's the purpose you want to give that metal for? Because if it's to preserve the value of your money, then your goal, it's set in there. Just buy it and use it as a protection, because technically gold doesn't generate any cash flow unless you're trading it in the market like you saw in the chart. But other than that, the actual physical gold is meant as a storage of value. You're storing that value and hoping that it will protect your money against inflation. So in the future, if you choose to liquidate, then you can go ahead and do that. But it shouldn't be used as a type of investment to generate cash flow, like, for example, a stock with dividends, or investing in real estate, in exchange of putting your property out there in the market for rent. So if you have the capacity to invest in gold, do that. Some other comments that I've seen is, if I've considered investing in silver. I personally have invested in silver, and I did not like the volatility. In fact, we actually liquidated our metals earlier last year, and the bulk of the gains were made in gold, but not necessarily in silver. We actually lost money in silver. So I've decided that I will just stick to whatever works, and that is gold. Now, I understand that depending on your purchasing power, buying gold might not necessarily be a viable way for you, but the good news is that, as you can see here, you don't have to go for the full ounce. You can buy grams of it, right? You can buy smaller coins or smaller, well, there's no such thing as a smaller, but well, there are smaller billions actually that you can buy. Anything that adjusts to your budget, okay? And so that's what I wanted to share about gold, for those who have been asking about gold. And one more thing, this is where the rates are sitting. So if you happen to be in the market looking to purchase your home, and you want to know what the rates are, this is the range. And as the same as the Kitco page, this page, Mortgage News Daily, upgrades in real time. Right now it's 8:16 p.m. New York Eastern Standard Time, but if you were to log in, let's say tomorrow at 2 o'clock, you will see the numbers changing in real time. So this rate that you see here, it's based on an average of all the people that were applying for mortgages today and locked in the rate. This is not a true reflection of what your rate is going to be like, but it's good to have a benchmark. If you want to get a true range, you should look at the numbers below here. For a 30-year mortgage, it's sitting at 6.01 to 7.13, or for a 15-year, it's sitting somewhere between 5.55 and 6.50. The below here, that's the rate for a 30-year FHA loan for those who are looking to apply for an FHA. And then if you happen to be a veteran, this is the rate that you should expect to see. And once again, this is a average, not the actual rate. Okay. I see someone who just Yogesh. Hi, hello. What do you think about refinancing to a higher rate, using the funds for another investment? That is a great question. And I usually get a lot of pushback when I mention this. Contrary to popular belief, a lot of people think that when it comes to refinancing, that you should always refinance only if there's a lower rate. That is only truth only if you're only refinancing the balance that you have left. It's only truth if your goal is to continue to minimize that mortgage payment. And even then, you should consider whether that's worth it or not, because every time you go through a refinance, that's a whole new mortgage application, and there's closing costs and there's transfer taxes associated with it. There's a lot of money that comes into play. Now, to your question, Josh, if you are looking to refinance because you, over the years, I don't know, let's say for example, you bought your property back in the pandemic, that means that you have amassed a good sizable equity in your home, right? And you're looking to buy another property. Yes, it does make sense to refinance even at a higher rate, because that equity is going to get you another asset that's going to generate income for you. So now you have two assets sitting in your play. So you shouldn't get fixated on the lower rate. So if you need to refinance into a higher rate to get access to equity, just get that new property. There's always an opportunity to refinance in the future again. That's just my opinion. I have done it. And for me, it has made sense. And so, of course, if you're going to refinance to buy another property, make sure that the new property that you're buying also makes sense number-wise. Make sure that the income that property is generating also can cover not just the operating expenses, but it also covers the mortgage as well. Okay, so hopefully that was helpful. Any more questions, please do let me know. I will stay around just a little bit. I'm trying to see if there's any additional upgrades that you should be keeping in mind, aside from the rates that we see here on the screen. I'm just going to minimize this here. So take a screenshot if you need to. This is where the rates are sitting at. I did do another live before this one, and somebody asked me if I foresee any changes to these numbers right here if you're planning to buy in February. So the short answer is no. There is no anticipation of additional rate cuts. Some experts do say that they anticipate 2 more rate cuts from the Fed, but that's not until later this year, meaning after the first half of the year. And then some other experts, like for example, Bankrate over here, they mentioned it somewhere. I will tell you. I don't know where I saw it, but in essence, their prediction is a little bit more aggressive. So Bankrate is anticipating, I think I saw that here. Yes. So Bankrate's annual interest rate forecast estimates another 3 cuts worth of 0.75 percentage points in 2026, meaning that there will be 3 additional rate cuts of 25 basis points each for a total reduction of 0.75. So that's to be determined. We don't know that. Like I said, investors are anticipating 2. Bankrate is anticipating 3. How do you know how that's going to affect you? It's just simple. So you can come in here and basically take this number let's say, for example, if you're looking at a 616 and we're talking about a 50 basis point reduction, that's 0.50. So you minus 0.50 to this number right here. So that means potentially at the end of 2026, the rates could go down to 6.16. That's assuming a cut also that shows into the mortgage. But remember, any rate cut on the Fed affects mainly car loans. It affects mainly your credit cards, any business loan. It doesn't affect directly any type of mortgage rate, but that's just in essence to show you how the rate reduction gets calculated. So to answer the question whether February will show any major changes, the answer is no, unless, I don't know, there's another catastrophe coming up or another pandemic, like something really, really major impacting the economy. That's when we're going to see some either major reductions or a major increase on the rates. Other than that, we are currently experiencing the lowest of the lowest of the past 3 to 4 years, based on what we are seeing in this chart right here. So if you have a house that is there waiting for you, or if you have plans to purchase that vehicle, you shouldn't hold off any longer, because once again, there are no anticipations of any additional rate cuts, at least not for the first half of the year. There will be for the second half of the year, and there will be no anticipations of no type of rate cuts whatsoever for 2027. So if you're going to do something, whether it's to buy an asset or invest in a vehicle for your business or get a loan for your business, now is the time. 2026 is the year to do that. Otherwise 2027 will just basically just remain the same. So that's all I have for the update. I see more and more people join. Welcome. Feel free to let me know where you're joining from if you like. Sometimes it gets a little lonely here when I don't see people commenting, but I do know you guys are connected. So I have Motivation with Jay. Hey, thank you for tuning in. Any other questions related to what I shared today, please do let me know now, so I can help you out before I disconnect. And if you happen to be tuning in after the live transmission, feel free to just leave the comment down in the section, the comment section below, and I'll do my best to reply back to you. So I don't see anything else. Josh says thank you. Okay, yeah, thank you. I'm glad I was able to help you out. Feel free to ask any additional questions in the future. Motivation with Jay, Tampa, Florida. Thank you for tuning in from Tampa. Tampa has seen some interesting movement. The market is currently going through some kind of, I want to call it recalibration, but it's definitely not a market downturn. So thank you for tuning in from Tampa. And then Josh, nice to see you. Thank you from Northern New Jersey. All right. Great to see everyone here. Thank you for your support all of these years, and feel free to let me know any type of suggestions that you want me to cover down in the comment section below. And until then, I will see you guys next time. Take care. Bye-bye.